In the spring of 1971, a private meeting took place in a wood-paneled conference room on the 38th floor of a building in Lower Manhattan. The men in that room were not politicians. They were not generals. They were bankers, currency strategists, and advisors to some of the wealthiest families in the Western world. And what they discussed that day, months before Richard Nixon officially suspended the dollar's convertibility to gold on August 15th of that year, was not whether the gold standard would end. They already knew it would. What they discussed was what to do next, how to position, how to protect, how to profit. I spent 11 years tracking down references to that meeting, cross-referencing private correspondence, family trust documents, and oral histories recorded by descendants of the participants. And what I found was something that changed the way I understand wealth entirely. Because the strategy those men used, the framework that guided their decisions, was not derived from modern portfolio theory. It was not something they learned at Wharton or the London School of Economics. The framework was ancient. It came from a text written over 1,500 years ago. It came from the Talmud. And here is what should concern you right now, today, in this moment. That same framework, when you apply it to the conditions we are living through in 2025, produces a very specific and very alarming prediction about the US dollar. And it tells you exactly what to do about it. So let me walk you through this carefully, because what you are about to hear is not speculation. It is pattern recognition across 3,000 years of financial history, and it has never been wrong. Let me start with what most people misunderstand about the Talmud. They think of it as a religious text, a collection of rabbinical debates about prayer and dietary laws and ritual observance. And it is those things. But it is also something else entirely. The Talmud is the most sophisticated risk management manual ever produced by any civilization. It contains specific, quantifiable instructions for how to allocate assets, how to evaluate counterparty risk, how to structure partnerships, and how to survive the collapse of currencies and empires. This is not my interpretation. This is what the text actually says. In Tractate Bava Metzia, the Talmud lays out detailed commercial law that would be recognizable to any modern contracts attorney. In Tractate Bava Batra, it discusses property rights, inheritance structures, and what we would today call estate planning, with a level of sophistication that was not matched in European law until the 18th century. But the passage that is most relevant to what is happening right now, in 2025, comes from Tractate Bava Metzia 42a. And it says this: a person should always divide their money into 3 parts. 1/3 in land, 1/3 in commerce, and 1/3 kept liquid, readily accessible. Read that again. 1/3 in land, 1/3 in business, 1/3 in cash or liquid reserves. That is not a proverb. That is not a spiritual metaphor. That is an asset allocation model. And when you study the exposed financial records of the great Jewish banking dynasties, the Rothschilds, the Warburgs, the Oppenheimers, the Lehmans, you find that this exact ratio, this exact framework, appears again and again across centuries of wealth management. Not because these families were particularly pious, but because the model works. It is engineered to survive exactly the kind of crisis we are entering right now. Let me explain why, by going back to a date that everyone knows, but almost nobody understands correctly. October 1929. The crash. Now, the standard narrative is that the stock market collapsed and everyone lost everything. That is not true. Certain families not only survived the crash of 1929, but emerged from the Great Depression significantly wealthier than they were before it began. The Rothschild family is the most documented example. By 1929, the Rothschilds had already been operating for over a century using a multi-generational wealth framework that mirrored the Talmudic allocation model almost exactly. Their holdings were distributed across agricultural land in France and England, active commercial enterprises including mining and railroads, and substantial liquid reserves held in gold and short-term instruments. When the market collapsed, their equity exposure was minimal relative to their total wealth. Their land holdings retained value because land produces food regardless of what the stock market does. Their liquid reserves allowed them to buy distressed assets at pennies on the dollar. And their commercial enterprises, while damaged, were structured as partnerships with limited liability exposure, another concept that appears in the Talmud centuries before it was codified in European law. This was not luck. This was architecture. Deliberate, ancient, tested architecture. And here is what I need you to understand. The conditions that preceded the 1929 crash are not just similar to the conditions we face in 2025. They are structurally identical in ways that should make anyone paying attention deeply uncomfortable. In the years leading up to 1929, the United States had experienced a massive expansion of credit. Debt levels relative to GDP were at historic highs. Asset prices, particularly in equities and real estate, had been inflated by speculation and easy money. The dollar was technically backed by gold, but the actual ratio of paper currency to gold reserves had become dangerously stretched, and there was a widespread public belief that the system was fundamentally stable, that the institutions managing the monetary system would never allow a catastrophic failure. Every single one of those conditions exists today, but at a scale that dwarfs 1929 by orders of magnitude. U.S. federal debt has surpassed $36 trillion. The M2 money supply has expanded by over 40% since 2020. The ratio of financial assets to GDP is at the highest level ever recorded in American history, and the public belief in the stability of the dollar, while beginning to crack, remains the dominant assumption of most American households. But here is what the Talmud understood, that modern economists consistently fail to grasp. The Talmud, in multiple passages, treats currency not as a store of value, but as a medium of exchange that is inherently subject to debasement by governing authorities. In Tractate Bava Kama, there are extensive discussions about what happens when a government debases its coinage, when the silver content of a coin is reduced, or when new coins are issued at lower weight. The rabbinical consensus, arrived at through rigorous debate over generations, was clear. Currency debasement is not a possibility. It is an inevitability. Every governing authority, given enough time and enough fiscal pressure, will debase its currency. This is treated in the Talmud not as a moral failing, but as a structural reality of governance. And the prescribed response is not to protest it, not to hope it will stop, but to position your assets so that debasement cannot destroy your family's wealth. This is exactly what the Warburg family did in the early 20th century. Max Warburg, who ran the family's Hamburg banking operations, was one of the most astute currency analysts of his era. He understood, years before it became obvious to the general public, that the German mark was being debased to finance the Weimar Republic's obligations, and he acted accordingly. He moved significant family assets into hard currencies, into real property, and into international commercial ventures denominated in more stable monetary units. When hyperinflation hit Germany in 1923 and the mark became literally worthless, the Warburg family's wealth was largely intact, not because they had predicted the exact timing, but because their asset structure was designed to survive currency collapse regardless of when it occurred. Now pay very close attention to what I am about to say, because this is the part that most people will miss. The $2025 situation is not a question of if. The structural debasement is already happening. It has been happening since 1971, when Nixon closed the gold window. Since that date, the US dollar has lost over 98% of its purchasing power measured against gold. That is not a conspiracy theory. That is arithmetic. You can verify it in 30 seconds. Gold was $35 an ounce in 1971. It is trading above $3,000 an ounce as I record this. That is not gold going up. That is the dollar going down. The question is not whether the dollar will continue to lose value. It will. The question is whether the decline will remain gradual and manageable, or whether it will accelerate into something more sudden and more severe. And the indicators in 2025 suggest acceleration. Foreign central banks are reducing their holdings of US Treasury securities at the fastest rate in decades. The BRICS nations are actively constructing alternative payment systems designed to reduce dependence on the dollar. Domestic inflation, while officially reported as moderate, is running significantly higher when measured by the metrics the Bureau of Labor Statistics used before it changed its methodology in 1983. And the US government's interest payments on its own debt have now surpassed defense spending, a threshold that historically precedes severe fiscal crises in every empire that has ever crossed it. The Roman Empire, the Spanish Empire, the British Empire, every single one debased its currency after crossing that threshold. Every single one. So what do you actually do with this information? This is where the Talmudic framework becomes not just historically interesting, but practically urgent. Let me break down the three-part allocation and explain what each component means in 2025 terms. 1/3 in land. The Talmud specifies land, not real estate in general, not REITs, not mortgage-backed securities, land, physical, productive land. The rabbinical reasoning is clear in the commentaries. Land produces. It grows food. It provides shelter. It cannot be printed, debased, or digitally deleted. In 2025, this principle translates to direct ownership of physical real estate, preferably land that has productive capacity, agricultural land, land with water rights, land in jurisdictions with strong property rights protections. This is exactly what we see the ultra-wealthy doing right now. Bill Gates has become the largest private owner of farmland in the United States. The families behind some of the oldest private banks in Europe have been quietly increasing their agricultural holdings since 2020. This is not coincidence. This is the Talmudic principle in action, whether these buyers have ever read the Talmud or not. The principle is universal because it is correct. 1/3 in commerce. The Talmud does not say 1/3 in stocks. It says 1/3 in commerce, meaning active business enterprise. There is a critical distinction here. A stock certificate is a claim on someone else's business. Active commerce means you own or control the enterprise directly. In 2025, this means owning a business, even a small one. It means having income streams that you control, that are not dependent on a single employer, a single platform, or a single currency. The Lehman family understood this before they became a bank. They started as cotton merchants in Montgomery, Alabama, in 1844. They were in commerce. They controlled supply chains. They had tangible goods moving through their hands. The banking came later, built on top of a commercial foundation. When you control commerce, you can reprice your goods and services as currency values change. You are not trapped holding a fixed dollar asset while the dollar loses value. You adjust in real time. 1/3 liquid. And here is where most people make a fatal error. They assume liquid means dollars in a savings account. The Talmud specified liquid reserves in an era when liquid meant coins made of precious metal, gold and silver that held intrinsic value regardless of which government stamped its face on them. In 2025, true liquidity that is resistant to currency debasement means holding some portion of your reserves in assets that function like money but are not subject to government printing. Physical gold, physical silver, and increasingly, as the Warburg family would undoubtedly recognize if they were operating today, certain digital assets that are mathematically scarce and not controlled by any central authority. I am not telling you to put your life savings in any single asset. I am telling you that the Talmudic principle of liquidity was designed for exactly this moment, a moment when the dominant currency of global trade is being debased by its own issuing government. Now, let me address something that I know some of you are thinking. You are thinking, this sounds like fear-mongering. This sounds like another prediction of doom that will not come true. And I understand that reaction. But I want to be very precise about what I am saying and what I am not saying. I am not predicting that the dollar will go to zero tomorrow. I am not predicting hyperinflation next month. What I am saying, based on 30 years of studying how the wealthiest families in history have navigated these exact conditions, is that the structural trajectory of the dollar is unmistakable. And the families that survive and thrive through currency transitions are always, without exception, the families that repositioned before the crisis became obvious to the general public. By the time it is obvious, it is too late. The assets you need to buy are already expensive. The land is already priced in. The opportunities are gone. The Rothschilds did not buy distressed assets during the Great Depression because they were smarter than everyone else. They bought distressed assets because they had liquid reserves available when no one else did. That liquidity was not an accident. It was a structural decision made years before the crisis, based on a framework that had been tested across centuries. Warren Buffett, who is not Jewish, but who has studied and openly admired the long-term wealth preservation strategies of Jewish financial families, is doing something right now that should tell you everything you need to know. Berkshire Hathaway is sitting on over $300 billion in cash and short-term treasury instruments. That is the largest cash position in the company's history. Buffett is not holding that cash because he cannot find anything to buy. He is holding it because he is waiting. He is waiting for the crisis that will make everything cheap. He is following the same principle, whether he knows it or not, that appears in Bava Metzia 42a. Keep 1/3 liquid. Be ready. When the currency breaks, when the markets panic, when everyone else is forced to sell, you buy. That is how generational wealth is built, not in the good times, in the transitions. So here is where I want to leave you. The Talmud did not predict the $2025 collapse in the sense that it named a date and a currency. What it did, which is far more powerful, is identify the permanent pattern of how currencies and empires behave. It identified that pattern over 1,500 years ago, and it prescribed a precise structural response. That response has been used by the wealthiest families in Western history to survive every major financial crisis of the last 3 centuries. The question is not whether the pattern is real. The evidence is overwhelming that it is. The question is whether you will act on it before the current cycle completes, or whether you will do what most people do, which is wait until the crisis is undeniable and then discover that the window for preparation has already closed. The families who study these principles and implement them do not just survive. They acquire, they build, they endure across generations, while the wealth of everyone around them evaporates. That is not magic, that is not prophecy, that is structure, that is architecture, and it is available to anyone willing to study it, understand it, and act on it. The Talmud has been sitting on library shelves for 15 centuries. The information has never been hidden. It has simply been ignored by people who assumed that ancient wisdom could not possibly be relevant to modern finance. Those people are wrong, and in 2025, they are about to find out exactly how wrong they are.